Hello and welcome to the Signia Wealth September market commentary. My name is Ammalan Annalingam and I am the co-head of multi-asset investments. September was a very difficult month for markets, with all major asset classes seeing substantial losses. Many traditionally safe haven assets also struggled, so the supposed free lunch of diversification failed to offer much support. The moves came as investors grew increasingly concerned about the onset of a recession, whilst also being concerned about central bank hawkishness and continuous aggressive interest rate hikes. The latter concern was fueled by the inflation print released on the 13th of September for August data, showing that whilst headline year-on-year inflation declined from a previous reading of 8.5% to 8.3%, this was still above expectations of 8.1%. In particular, what was of concern was the month-on-month core inflation number, which excludes food and energy, rising from 0.6% from a previous reading of 0.3%, and expectations of 0.3%. In fact, on the day of the inflation release, the S&P 500 was down 4.3% and the Nasdaq was down 5.2%, each having their worst day since June 2020. As can be gathered, equity markets were strongly down in September, with the S&P 500 down 9.2%, the Euro Stoxx 50 down 5.5%, and the FTSE 100 down 5.2%. And the MSCI Emerging Markets Index was down 11.7%. Added to this were major disruptions to Europe's energy supply and some serious market turmoil in the UK following the government's fiscal announcements, which unveiled the biggest programme of tax cuts in half a century and to be funded by additional borrowing. Sterling fell on the back of the announcement, hitting an all-time intraday low of $1.035 against the pound. Gilts, unsurprisingly, also got punished, bringing their year-to-date decline to minus 26.6%. In particular, what spooked markets was how explicit central bankers were about willing to raise interest rates even if growth were to slow. For example, the Federal Reserve's latest projections show that policymakers were willing to keep rates in restrictive territory even if it meant an increase in unemployment. This is notable given part of the Fed's dual mandate is to promote effectively the goals of maximum employment. Bonds didn't provide a safe haven at all, with the broad-based index down 3.2%. And commodities provided no respite despite the broad-based index, which was down 8.4% as USD strengthened diminished commodity values, whilst growth concerns dragged potential commodity demand down. Gold, which is often touted as a flight to safety asset, was down 3.2%. That's it for this month. Thank you for listening.